Hello, this is Tim Congdon, Chair of the Institute of International Monetary Research at the University of Buckingham. It's October 2023. In these videos, I can talk about a range of things. I talk about money supply trends and what that then means for economies. This particular occasion, I'm going to be talking about a large subject, a subject which is getting ever larger, and I'm afraid which is becoming much, much too large. I'm going to be talking about the American public debt. It does feed back the monetary situation, because if the American authorities borrow from the banks to finance their deficits and their debt, that creates new money balances with effects on the economy. But what I want to do in the next few minutes is really just to focus on the size of the debt and the way in which it's growing at the moment. I sent out a special email on the 4th of September, it's a few weeks ago, when I became aware of the latest trends in the American public debt. In May of this year, the Congressional Budget Office had forecast that in the 2023 financial year, the deficit of the American federal government, the federal deficit, would be $1,500 billion. Just for clarity, the American fiscal year runs from 1st of October to the end of September. So when I looked at this subject in early September, I had numbers for the first 10 months of the year. I didn't have August, by the way, but I had the first 10 months of the year. And what became apparent was that already the CBO's estimate of $1,500 billion was wrong, and not just wrong by a tiny bit, it was massively wrong. Also, I thought. Because in the corresponding months of the 22 year, the deficit in August and September had been over $400 billion. And month by month in 23, the deficit had been higher than in 22. So I said, forecast that the federal deficit in the 23 fiscal year would be as much as $2,200 billion. I think that was a reasonable thing to do. And, well, let me confess, I've been wrong. We now have all the figures for the whole of that year to the end of September 23, and it was $1,700 billion. But I don't need to apologize, because it's very clear that the American Treasury has been fiddling the books, in the sense that in those last 2 months of the 23 year, it was suppressing expenditure in an artificial way. In August itself, US federal expenditure was 60% lower than in August 22. That clearly isn't the truth. And what's going on was that the US Treasury, aware of this huge overshoot that was taking place, deliberately clamped down on paying out, making payments in the final few weeks of the fiscal year. Just look at these. You can see from this chart that the drop in federal expenditure between August 22 and August 23, that drop in 1 month over a year, was larger than in any other monthly occasion for 40 years. That's not the truth. The truth is that the American federal deficit is running somewhere in the range of $2,000 to $2,500 billion on an underlying basis. Now, US GDP in the middle of 2023 was around about $27,000 billion. So we're talking about a deficit of the order of 8-9% of GDP, 7-8-9% of GDP, something of that sort. And this is while the US economy has had a relatively resilient 2022 and 2023 after the strange boom of 2021 following COVID. And if you were to, unemployment's very low. If you were to have a more normal cyclical situation with somewhat higher unemployment, then the so-called structural deficit, the cyclically adjusted deficit, is more like, say, 9–10% of GDP. Economists refer to the cyclically adjusted deficit as kind of the underlying figure that. Now you may think, why am I saying these things? Am I just sort of the figures on the monthly deficits are as they are, but I thought I'd just have a look at the latest pronouncements from the International Monetary Fund. You could hardly get a more authoritative source, just to make sure that I'm not talking through my hat. The IMF produces each year a World Economic Outlook in April and October. So the October numbers are very new and reflect the IMF's latest views. And here is a chart showing the IMF's views of the structural, cyclically adjusted deficit, both for some past years and for the future. So past years are now given. So what I've done here is to compare the April 2023 estimates with the IMF's latest view in October 2023. You'll see the huge deficit in 2020, 2021 related to COVID, coming down, of course, in 2022. But the IMF has actually raised its estimates of the structural deficit, and look at 2023. They have raised their estimate of the structural deficit by 2% of GDP, a bit more than $500 billion, rather in line with my early September special email. I wasn't making things up. There really is a problem. Okay, well, let's then have a look at the IMF's projections of the ratio of gross public debt in the USA. This is debt both of the federal government and of the state governments, it should be said. The gross public debt, mostly federal, but the gross public debt to GDP ratio in the USA in the more or less the rest of the 2020s. This is a chart goes back to just before the Great Recession. You can see that 2006, the ratio of debt to GDP was a bit over 60%, quite in line with other advanced countries, not out of line with American history. Then there was the Great Recession, which pushed up that ratio sharply, didn't come down in the 2010s. Then COVID pushed down GDP for a period, pushed the debt up to that sharp, come down a little bit in 2022, and then I'm afraid it just keeps on rising. And towards the end of this projection in 2028, it is heading on for 140%. Now, for most of my career, Italy has been regarded as a bit of a fiscal delinquent. The nation in Europe with very high public debt so high that it's antagonized its neighbors, had negotiations and tension with the European Commission, and so on. That figure for the USA is not that different from what is currently the case for Italy, and it's much higher than has been normal, even in Italy, in the last 20 or 30 years. Let me just get that over again. The American public debt is heading for the same kind of area, the same kind of number that we've seen in Italy typically in the last 20, 30 years, when, as I said, it's been regarded as something of a fiscal delinquent. Okay, that's the message I want to hammer home. But you might ask, well, so what? Why does this huge public debt matter? Well, in the extreme, large public debts are financed exclusively from the banking system. That's when governments have lost all their credibility with non-bank investors or foreign investors, and they have to borrow from the banking system, even from the central bank. In those cases, the rate of money growth is explosively high, and you get hyperinflations. I'm not suggesting that's imminent in the USA in the next few years. In fact, at the moment, money growth in the USA is very low, and so one would be expecting inflation to fall in 2024 and 2025. However, one has got to be in this subject thinking ahead decades, and let's just be clear that there are no examples, and I'll put this forward as a law, there are no examples of a nation having interest on the debt in excess of 15% of GDP. There was a book about a decade ago by Reinhardt and Rogoff called This Time It's Different, meaning of course this time it's not different, but this time it's different, where they suggested that there was a kind of 90% of GDP tipping point in that public debt to GDP ratio. That work resonates, but it's not been widely accepted. And of course, there are nations like Japan that have got debt that's twice GDP, but the interest rate is 2 or 3%. So the debt interest ratio is 4, 5, 6%, which is manageable. Okay. It's when you get up to these very, very high numbers of debt to GDP and more normal levels of bond yields that you get into trouble. So we want to be looking at what's happening to that ratio of debt interest to GDP and sensing whether there's prospective trouble coming up. Now, obviously, the ratio of debt interest to GDP depends on two things. It depends upon the interest rate and that ratio of debt to GDP. Those are the two things that matter. Once we get up to these numbers, like getting on towards 10%, 15%, completely unsustainable. In the USA, I've just talked about the debt to GDP ratio. What about interest rates? Well, we had a period in COVID and just after COVID when interest rates were extremely low. In my view, very foolishly, bizarrely low, but that was what was going on. We're now up to more plausible, normal kind of number. The Treasury bill rate, closely related, Fed funds rate is about 5%. That gives people, because investors, some kind of defense against inflation. But typically, in the last 30, 40 years, bond yields have been quite a bit higher than that, and it's bond yields that really matter to the cost of servicing the debt. Average Treasury bill rate, the last, since the 1930s, about 3.5%. Bond yields, 10-year area, more like 6%. In the 1980s, bond yields, the long end in the USA, went well into the double digits. They went up, I think, to 12, 13%. I just need to check the figure, but that kind of number. Now look, if your debt to GDP ratio is 140%, and the cost of servicing the debt is 10% or more, the debt interest cost is 14% of GDP. You're getting towards that 15% limit. If the bond yields more into double digits, you're through it, you're bust. Well, you're bust. Basically, every nation that's got this situation has inflated the debt away. We have had an example in the relatively recent past with Greece, where it did have numbers of this sort, and then in the end, because in the Eurozone it couldn't inflate the debt away, so it had years of agony. It did default on its debt, and so on. Look, am I fantasizing? Am I exaggerating? Look, here is the ratio of debt interest to GDP for the USA, going back to, when is it, something like, I suppose, the 1940s. This is basically the entire period since the Second World War. You can see that in the Reagan period, 1980s, it was 5% of GDP. And that, by the way, was the result of the sky-high bond yields and Reagan's tax cuts, supply-side economics. That did cause the ratio of debt interest to GDP to get to 5%. Clinton then reduced the deficit. ratio of debt to GDP fell heavily as well, and then just starting to spike up now. And in the last 18 months, it's been that surge in debt interest costs that's been part of the reason for the overshoot on the deficit that I talked about at the start. You know, this is a subject in which there are vicious, self-reinforcing cycles. When things go wrong, they get very badly wrong, and it reinforces itself over time. It's because of the behavior of the debt interest bill. Now, where do we go from here? I'm not the only person to have noticed that there's a problem here. Rather strangely, just a few weeks after I sent out my special email, Paul Krugman wrote a column in the New York Times on the same subject. And he's a Keynesian who historically has been opposed to any kind of fiscal tightening. Even he now accepts the deficit is too high, the debt is unsustainable, and something's got to be done about it. But he says very simply, nothing will be done. And he says nothing will be done because of the American political situation. You know, we have, I'm sorry if I upset people what I'm about to say, we have two unsatisfactory, discredited figures, Trump and Biden, who are currently expected to be the contenders in the next presidential election. Does anybody expect them to do something about this subject? Anyway. You know, this is a chart from the Congressional Budget Office prepared actually in September 2020. Before much of this very recent news, you can see they're expecting this is not the gross debt, it's the net debt to GDP ratio to move up to twice GDP by 2050 in the USA. The CBO, of course, is non-partisan. This is pretty amazing that they can publish this kind of stuff, but that's what they did. So, just to be clear, that's the net debt to GDP ratio. That would imply a gross debt to GDP ratio more like 230%. So suppose you've got 7-8% bond yields, you're way out of unsustainable. It's completely unsustainable. Look, I don't know what's going to happen. Nobody does. There was after Krugman, I come on to a chap called Herbert Stein, who was a famous conservative economist in the USA. And he said, if something cannot go on forever, it will stop. This will stop somewhere. I don't really know how and when, but it will stop somewhere. I will finish by a quote. Again, this topic is starting to get very much into the forefront of public attention. I'm going to quote from Larry Summers, often said to be Obama's most important economic advisor in practice. And on the 18th of September, at a lecture at the Peterson Institute in Washington, Larry Summers said this. You know, looking at all these numbers I've just been going through, I would suggest that substantial and accumulating deficits and debts are a substantial threat to national security and national power. It's US national security, US national power. Budget deficits a decade out, comfortably in double digits as a share of GDP, now seem a reasonable projection. I don't agree with that. They can't happen. They're completely, if something cannot go on forever, it will stop. You can't have deficit 10% of GDP forever. They'll move up into 250% and so on. It's impossible. I think it is, listen to Larry Summers again, I think it is reasonable to ask the question, how long can or will the world's greatest debtor, that's what these numbers are talking about, the greatest debtor, be able to maintain its position as the world's greatest power? Amen. Thank you.